All right, hello, good day. My name is Albert Gabriel, and I'll be presenting an analysis of the UK electricity production company, sector over the past 10 years. So this presentation is going to be highlighting some key findings from a comparison of five major electricity companies in the UK. So we're focusing on their profitability, tangible assets, liquidity, and trends. So I've used descriptive statistics, visual trend analysis, and regression models to understand the performance drivers in the industry. So as you can see, this electricity sector has actually faced significant external shocks. The COVID-19, the Brexit, global conflicts, and also transition into renewable energy. So these factors have disrupted operations and increased costs. You know, Now the question now is which companies have been able to stay competitive and which strategies have allowed them to do so, how they have managed their profitability, efficiency, internal resources, and amidst these things that were happening. So you can see the data set analysis. You see 2014 to 2023, that's where we took the data from, of five electricity producers. So the key metrics include profit margin, turnover, net tangible assets, liquidity ratios, and number of employees. So these indicators will help us to measure how the firm has adapted to both external pressures and internal strategic decisions. So the profitability and the liquidity ratio, you can observe that Scottish Power showed stable profit margin throughout the period. OVO Energy, their profitability and poor liquidity highlight potential financial instability. A UK Power Network also maintained a healthy liquidity position, which reflects the solid cash flow and risk management. So this intercompany contracts reveal how the firms navigated debt and cost and market uncertainties. So the trend analysis of employees and assets. We observe from the graph, we see that Northwest Electricity Network showed the highest tangible assets consistently from 2014 to 2023. The assets increased sharply from 2014 to 2016. Then it reduced around 3.5 billion on 2023. So this suggests that early investment followed by stable asset management, also indicates strong infrastructure based on operations. So the British gas, you see that the much lower line of the tangible assets than the Northwest electricity. So mostly flat time over within major variations. So this indicates that British gas may be more service oriented with less resilience on tangible assets. So possibly also reflects outsourcing of infrastructure or the use of equipment facilities. For Scottish Power or the green line, you will see that it shows a low and stable tangible assets throughout the period. So it might suggest that there's minimal investment in tangible infrastructure or they're adopting a lean asset strategy. And UK Power sector, on the other hand, is actually similar to Scottish Power. So negligible tangible asset over time. So this might actually indicate uh, that there's a contrast service model or operation shared infrastructure. So OVO Energy also displays very low tangible assets, remaining almost flat. So it could also suggest that they are more digital or retail energy provider with low physical infrastructure. So if you look at the graph properly, you see that the trend, you see that Northwest Electricity Network shows large-scale investment and ownership of tangible assets, like for example, grid infrastructure. So other companies who are operating much lower tangible assets may reflect different business models in the regulatory environment or market rules. And the implication of all of this analysis is that Northwest Electricity is likely a major distributor, network operator, owning much of the grid infrastructure, while British Gas and others may likely more be customer-facing suppliers or service-based entities with lower capital-intensive operation. So the asset strategy divergence points, fundamental rules within the energy ecosystem. From the employee trend, you see that the British Gas significantly downsized its workforce, maybe due to restructuring. OVO Energy also showed some irregular staffing pattern, maybe due to financial instability. Power Network maintained the employee, prioritizing operational continuity. Northwest and Scottish Power made some moderate reductions, indicating efficiency moves without major uphill. So for the summary of statistics, you see that the average profit is 6.24 with a median of 6.47, showing slight skewness. So high standard deviations in profit and liquidity reveals industrial volatility. So these figures suggest that average alone can be misleading. So it's essential to understand variability and extremes to grab the company's resilience. So here the correlation inside, you see that non-tangible net tangible assets showed moderate positive correlation with profitability. Liquidity had a weak connection, and employee count had almost no connection. Liquidity and employee count. So this implies that not all managers control variables significantly influence profits. Strategic capital allocation can matter than staffing decisions. So you see regression analysis, the regression between liquidity and profitability was statistically insignificant. R2 close to zero suggests that liquidity does not meaningfully explain profit outcomes. So the multi-variable models are necessary, incorporating turnover, tangible assets, and market factors to build accurate forecasts and strategies. So here we talk about the recommendation and some conclusion as well. The profitability varied year to year, and they're shaped by external shocks and internal decisions. So we can also see that investment in tangible assets appears to be a strong predictor of resilience and growth, as liquidity and workforce size, while important, had weaker links to profitability. So for future strategies and recommendations, firms should prioritize infrastructure and renewable investments. They should also maintain stable but flexible liquidity. And lastly, companies should focus more on capital intelligence and just workforce scaling. Thank you very much.